Hi guys, welcome back to my channel. Kelvin here. A while ago, I made a Syfe review video, and down in the comments, you guys be like, we should have a higher return in the short term more. Which portfolio video do you recommend? I'm confused over global REIT and the 3 core portfolios. Yes, I know that Syfe portfolios are super confusing because Syfe be like, portfolios everywhere. And you guys have a lot of trouble deciding which one to use. So in this video, I will go deeper into each of the portfolios and explain what's the purpose for each of them. I will show you each of their holdings, their past performance, and tell you which portfolios are suitable for what kind of scenarios. Finally, I'll give you a quick summary so that it's easier for you to decide. So let's not waste any time and let's jump right in. Okay, so here are all of Syfe's 7 portfolios. You have Cash Plus, REIT Plus, Core Defensive, Core Balance, Core Growth, Global ARI, and Equity 100. Each of these portfolios have different style of investing, different purpose, and have different risk levels. I'll go through each of them, starting with Cash Plus first. Cash Plus is super safe because it invests into the super duper safe funds by Lion Global. The fund names sound very cheap, but basically they are just short-term, low-risk government bonds, corporate bonds, and high-quality interest rate securities. Or in short, safe investments lah. As of right now, Syfe is projecting a yield of 1.5% for Cash Plus. And because it is an investment, you can still lose money in this account. Based on past history, the worst you would have lost was negative 0.73%. So for example, in normal times, for every $100 you put in, you can earn $1.50, which is ain't much, but it's already much higher than those self-declared high-interest savings account, but give a very low interest rate. DBS multiplier. But the risk of investing in Cash Plus is that when times are super bad, you can lose up to 73 cents for every $100 you put in. So when should you invest in this portfolio? Whatever money that you need in the short term, invest in this portfolio. Maybe next month you need the money to marry your BE, or you have 100k renovation coming up, or even your 6 months emergency funds. Basically, money that you absolutely cannot lose. This portfolio is the best for you. Next is the REIT Plus portfolio. As the name suggests, this portfolio invests in Singapore REITs. If you do not know, REIT stands for Real Estate Investment Trust. Basically, they are just companies that own property buildings. You know, those kind of monopoly buildings, where your friend step on it and you take his money forcefully. There can be any kind of buildings like shopping malls, hotels, office buildings, logistic warehouse, hospitals. And just like monopoly buildings, the company get to collect rental money every month, and some of that money will go to investors. So the main purpose of this portfolio is for dividend income. But investing in this portfolio, you will get paid every 3 months. If you check REIT Plus dividend history, you will see that the dividends will go up and down every year, and the average yield is about 5.8%. But of course, you will also have to see the performance of the portfolio itself, right? It would be funny if they gave you 20% dividends, but the investment dropped by 50%. First REIT. If you check REIT Plus history, starting from 2011, we can see that the past returns fluctuate wildly every year. Sometimes it can drop to negative 9%, sometimes it can go up by 46%, but overall it has been going up because stonks. From 2011 to 2020, the annualized return is 12%. But some people don't like their portfolio to go up and down like a crazy horse. If you are that kind of person, Syfe also allows you to add in a risk management portion to it. Basically, what it does is throw in some bonds into the portfolio. That's because bonds can provide stability. So for example, when times are good, they will reduce the bond percentage. But when times are bad, they will increase the bond amount. So right now, the market isn't doing so well, right? Their bond percentage is about 47% of the entire portfolio. But in return for a more stable portfolio, you will have lesser REITs, which means you will have lesser dividends. Without bonds, the average yield over 6 years is about 5.8%. With bonds, the yield will drop to 4.9%. Same for portfolio performance. Without bonds, the annualized return over 14 years is 12%. With bonds, the annualized return drops to 8.9%. So when should you invest in this portfolio? You should invest in this portfolio if you want to receive consistent passive dividend income. If your investing horizon is long, maybe 5 years and above, just go for 100% risk, because over the long term, 100% risk will definitely give a higher return. But if you have a short investment horizon, like maybe 2 to 5 years, use the REIT with the risk management feature. You won't get the best return, but at least your portfolio wouldn't drop so much, like your exam score. Alright, the next portfolio is Equity 100. Just like the name says, this portfolio is 100% in equity. But rather than investing directly into stocks, this portfolio invests into ETFs which host stocks. The ETFs are diversified among many different sectors like tech, consumer discretionary, consumer staples, healthcare, etc. They are also diversified among a few countries like US, China, Japan, UK. Basically, diversification. For the past 10 years, the annualized return is 14.2%. When compared among all the other Syfe portfolios, Equity 100 will give the highest return because it invests in equities, and historically, equities will grow much faster compared to any other asset class. So when should you invest in this portfolio? Invest in this portfolio if you are young, you don't need to have dividend income, and have a high risk appetite. Like, you don't mind eating losses for breakfast for a few months in a row. Because if you can hold this portfolio when times are bad, then you will deserve the good returns when times are good. As you can see, the risk for this portfolio is 4 triangles, which is the highest among all the other portfolios. So if you invest in this portfolio, you will need to hold long term, like over 10 years or more. If you can do so, you will be rewarded well. But what if you can't hold long term? Maybe you need to use the money within 10 years. Or maybe you don't have diamond hands, especially when you see your portfolio drop by over 33% in a year. In that case, Equity 100 is not for you, but Syfe has got you covered. Introducing Syfe Core. Syfe Core is basically Equity 100, but you add in bonds, gold, and everything nice. And you have Syfe Core. Because with bonds and gold, your entire portfolio will become more steady for BP. They have Core Defensive, which only has 20% equity and 71% in high quality government and corporate bonds, and the rest in gold. So with so much bonds, it is much more stable compared to Equity 100. It won't drop too much when times are bad, but also won't go up too much when times are good. Maybe you want a bit more risk, but it's still very conservative. In that case, you can choose Core Balance, which is perfectly balanced as all things should be. It has more equity with 39% in equity, 50% in bonds, and the rest in gold. Or maybe you still want more risk but lesser risk compared to Equity 100. Then you can choose Core Growth, which has 70% in equity, 25% in bonds, and the remaining 5% in gold. Let's compare the core portfolio performance with Equity 100 performance. I'll be using the data starting from 2013 because Core only has data starting from 2013. As you can see, the returns increased from defensive to core balance to Equity 100. Core defensive had the smallest fall at only negative 3.12%, while Equity 100 had the biggest fall at negative 4.28%. But take note that this doesn't paint a clear picture because if you look at S&P 500, the biggest fall is actually in 2008, where Equity 100 dropped by negative 34%. I'm sure that the core portfolios dropped much lesser than that, but since I don't have any data, I can't show you. So don't be fooled by the small fall amount in this table, because if a real crash comes, at the highest risk, you can easily lose 1/3 of your entire portfolio when you are invested in Equity 100. So here's a rough guide on what the investing horizon should be for each portfolio. If you only have 2 to 3 years to invest, go for Core Defensive, which is the safest. 3 to 5 years, Core Balance. 5 to 10 years, Core Growth. And if you have more than 10 years, go for Equity 100 for the highest returns. Okay, that's for core portfolios. Finally, we have Global ARI. ARI stands for Automated Risk Managed Investment Strategy. So this portfolio is the most special among all the other portfolios because it has Syfe's algorithm controlling it. What do I mean by that? If you take a look at the portfolio page, you'll be able to choose your downside risk from 5% all the way to 25%. So if you choose 5% downside risk, most of the time you will only lose 5% a year. Or if you choose 25% downside risk, most of the time you will lose at most 25% a year. As you can see, if you choose a higher risk, you will have more equity. Your returns will be higher over the long term, which also means you will experience higher downside risk when times are bad. And if you scroll all the way down to 5%, you will have bonds, lots and lots of bonds. The annualized return will drop to only 4.2%, but you will lose the least amount of money in any given year. Now, the Global ARI portfolio doesn't only prevent downside risk when times are bad. When times are good, it also changes the portfolio so as to give you a better return. So for example, in 2008, when the market is crashing very hard, all the investors were like, you die, I die, everybody die. Global ARI 15% downside risk only allowed the portfolio to drop by 15%. As you can see here, the ARI changed the portfolio multiple times. Then, when times are good, ARI adjusted the portfolio to achieve a better performance. So now, you guys might ask, core portfolio and Global ARI like same, both got equity, bonds and gold, which to choose all? Okay, take a look at this. The blue line is Global ARI, the orange line is core portfolio. most of the time, global ARI will drop much lesser compared to core portfolio. That's because in the market downturn, global ARI will auto-rebalance your portfolio to reduce downside risk, while core portfolios will be like, market downturn is actually a good thing for long-term investors because you get to buy things at a huge discount. So here's how to choose. If you're consistently doing dollar cost average into the portfolio, choose core portfolios because it allows you to buy the dip. But if you are doing lump sum investing, meaning you all in a huge amount of money right at the start and don't contribute anymore to it, then global ARI is better. Okay, if you didn't get anything that I said just now, here's a too long, didn't watch version. For cash that you absolutely, definitely, really cannot lose, like your wedding money, house money, savings, put it in Cash Plus, you get around 1.5% return plus minus. If you want to receive passive income from your investments, invest in REIT Plus. For investing horizon with 5 years and below, choose REITs with risk management. For more than 5 years, choose 100% REITs. Next, if your investing horizon is 10 years and above, and you don't need all those dividend incomes, choose Equity 100. This portfolio will give you the highest returns out of all the rest. That just leaves us with core and global ARI. Both of them are really similar. If you are consistently doing dollar cost average, choose core portfolio. For 2 to 3 years investment horizon, go for core defensive, which is the safest. 3 to 5 years, core balance. 5 to 10 years, core growth. But if you are doing lump sum investing, choose global ARI. The ARI algorithm will reduce your downside risk while trying to increase your returns. But of course, you don't have to only invest in one single portfolio. You can be like,
¿Por qué no los dos?
Syfe's suggestion is to have a barbell strategy. Basically, you have 50% in Equity 100 for the highest return and 50% in REIT Plus for passive income. How you want to invest in Syfe is totally up to you, but I have a special deal for you. If you sign up to Syfe, you can just use my code Kelvin while signing up to enjoy a 6 months free waiver up to a deposit of 30k. And that's all for today. Let me know down in the comments below, how are you investing in Syfe? Like, share, subscribe as I'll be posting new videos every Monday and sometimes Friday.